Hello, this is Joe Pryor with the Virtual Real Estate Team in Oklahoma City. And I'm starting a new series on investing in real estate in the Oklahoma City market. And this is the first of a series, and we're going to start with return on investment. But what I want to talk about before I get to that is that I don't think that there's a better time to invest in real estate than right now. We've been through an historic problem in the real estate industry. We have seen prices drop. In most areas, they've bottomed out, but prices are at historic lows. And so this is the time that investors should always come in to buy real estate, because the old adage of buying low and selling high has never been more true. But how do you quantify a real estate investment? How do you know that you're making the right investment? Well, one way of doing that is to compare your investment against other types of investment. In that particular respect, your realtor needs to know the numbers. One of the important numbers is IRR, internal rate of return. Simply put, this is how much money we're making off our initial investment as long as that initial investment stays in the home. So what we do to start with, of course, is what is the price of the house? What are we buying? Now, this is where it's important in terms of internal rate of return to get a good deal, because not only do we measure this in terms of, well, this is my return annually in terms of a percentage, but also long-term wealth accumulation. So if I can help you buy a short sale or a repossessed distressed property, and with everything that you've got into it, you still have $30,000, $50,000 worth of equity, you're really ahead of the game when it comes to 5, 6, 7 years down the road. That's number one. Then the second factor is, what are we putting into it? 5%, 10%, 20%? Now there's 20% down Fannie Mae loans. There's also some special Fannie Mae's on REOs at 10. There's also VA financing at 5%. We'll discuss that with you, because any investment that you make has risk. I don't care what kind of investment it is, whether it's a CD at the bank, going to the stock market, or going to the tables at Vegas. There's a certain amount of risk involved, and we have to balance the risk as versus the return. And so how much money you have into the investment either minimizes or possibly maximizes your risk, but also on paper, 5% down can look really good. Now, we always start with positive cash flow. That's one thing I want to emphasize to you, is that real estate should be not speculation. It should be income-producing properties. So we have our price, hopefully with equity. We have our initial amount of money that we put into the investment. Now, that investment includes down payment when that initial amount, and also closing cost. Then there's another factor, which is, do we need to fix the house up? So we have to evaluate how much money goes into making the house rentable to begin with. So those are the essentials of the beginning position. Then after that, we have vacancy rate. Every market has vacancies. Some are more, some are less. Even if you have a small vacancy rate, there are going to be times when there's a 30-day delay. Maybe you need to do a little bit of work on the property 2-3 years into it. Maybe there's a delay between the time somebody gets out of the house to the next renter comes in. So vacancy rate is a crucial part also. Now, in vacancy rate means that we also probably have a property manager, which you don't want to be your own property manager unless you do it full time. That's what they do professionally. They shield you as best they can from getting someone that may tear up your property or doesn't have a good credit rating. But you're going to pay for that, and so we factor in that also. We factor in the amount of money on a monthly basis, usually 8 to 10% is normally what it is in terms of what the property manager charges. We also know that we're going to have periodic maintenance on the property, and if it's a newer property, it may not be as much, but we're going to try to be conservative on this, and we're going to say, okay, it's going to be $400,000, $500,000. Depending on the type of property, what can we expect that there's going to be an annualized maintenance amount? Now, I'll get into taxes at another time in terms of how you write these things off, but that's one of the things that we put in there. Then there's a reinvestment rate. Now, this is the good news. Let's say you're making $350 a month on the investment. With that $350 a month, you want to put it into something at least that's safe, like a money market account. Maybe it yields you 2.5%. But that's something that stays in the investment, because you're taking that money and not spending it on a new car or a vacation. It's real estate money that you're holding on to, or possibly reinvesting into another property. Finally, we compute a timeline. 5 years, 7 years, 10 years. How long do you think you're going to own the property? Now, once we've factored all these things in, then I have a computer program that spits the numbers out. Now, you got to know what numbers to put in, and you got to know your market extensively, because there shouldn't be too much of a guessing game involved in this. You need to know historically what the market is doing. And so when you put those numbers in, knowing the numbers comes out with something that you can believe in. Then I get two numbers. I get a number that's an annualized rate of return, which is pre-tax and after-tax, and I get a long-term wealth accumulation. One of the reasons we want a pre-tax return is because we want to compare it to other investments. Let's say in real estate, I show you, my gosh, I'm getting 26% annualized return over 7 years on my money. That's how much it's making. Well, I'm only getting 20% or 15% on another type of investment, which may be a mutual fund, or I'm only getting 2% into a CD. And so you want to be able to compare those numbers to decide how much money you want to portion to real estate, and to factor in, is this a low risk investment, and it is a higher return for a low risk investment. We do after tax because at some point you're going to say, well, maybe I just want to cash out. Maybe I've had this property for 7 years or 10 years and I just want to cash out. And so we do that afterwards also. We show you what it would be if you just ask for your money, because there's a couple of taxes that you do pay when you do sell a property. Now, at a later date, I'll also talk about 1031 tax-deferred exchanges, which allows you to take your money after you've sold your investment property, defer your taxes, and put it into more property, like 1, 2, or 3 more properties with the profits you make. Well, that's return on investment. In the next video, I'm going to do a return of investment analysis and show you what cash on cash will mean to you, because that's important also. So this is Joe Pryor with the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values with the speed of technology.